Hello, Merck employees. Welcome. Thank you so much for joining us today. My name is Samantha, and I'm in Client Services here at the Retirement Group. I moderate these weekly webinars. Today, you are joining us for one of our weekly question and answer sessions where our advisor, Tyson Mavar, will be joining us shortly to answer some of the most asked questions we've been getting lately from Merck employees. Today they'll be surrounding 401k missteps and inflation. Before I bring Tyson on, however, I'd like to just remind you that although we work very closely with both active and retired members of the Merck community, we are not affiliated nor endorsed whatsoever by Merck. The Retirement Group is a completely independent group of financial advisors, so please keep that in mind. And with that, I'd like to introduce you to our speaker today, Tyson Mavar. Hi, Tyson.
Hi, Sam. Thank you, folks, for attending our webinar series today. My name is Tyson Mavar, one of the retirement specialists for the Retirement Group in Texas. And today we're going to talk about some recent questions that we've received from our clients and prospective clients relating to various retirement benefits plans, specifically pensions and 401ks, and some impacts to these plans as a result of inflation that we've seen higher numbers in the last couple of years with. For those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization that specializes in helping corporate employees plan for and transition successfully into retirement. We also manage retirement assets for retirees of the companies that we specialize in the retirement process of. And if you're on today's call, it's likely that one of our advisors, myself or another one of my colleagues at the company, has clients from your company and can explain to you different strategies related to your specific company benefits plans. We also encourage everybody, whether or not you're a client of ours, to take advantage of a resource we have available called a retirement cash flow analysis, wherein we will take your current benefits plans, pension, 401k, outside financial assets, illiquid assets, and help you develop a budget depending on what your current expenses are and what we could foresee as future changes to expenses, and run your numbers to make sure that you're on track, but also to identify strategies to where you can have a more successful retirement plan, whether that's changing how you're saving into your 401k, changing how you're invested in the 401k, reviewing various different options on how to take your pension, lump sum versus one of the many annuity options you might have, a variety of different tax issues related to all these benefits plans, ultimately to give you the most successful retirement plan possible by minimizing your taxes and maximizing what you walk away from your company with. So take us up on that if you haven't done so yet. It's a complimentary service. And if it's been a while since we've updated your analysis, let us know that as well, because we have seen many changes in just the last year to interest rates, to inflation, and to the financial markets. Now, we've got quite a few questions this last couple of weeks, so we're going to go through 4 of them that we thought were pretty relevant. So the first question, how will inflation affect my pension if I choose the annuity? So every company is different in terms of what they will offer you as a way to take your pension. Just not every company offers a lump sum. Some companies only have a lump sum option. If you take your pension as an annuity, as a monthly benefit that's good for the rest of your life, that's pretty consistent among all plans, that everybody has a single life annuity. And then every company is different on whether they will offer a joint survivor annuity, a period certain annuity, a leveling income annuity, a different way to ensure income for the rest of your life and maybe spouse's life in many cases. Now, this question is asking, how does inflation impact the annuity? The higher inflation rates are, of course, the higher cost of living goes over time, which means your annuity will become less valuable if it's not connected or if it's not indexed to inflation. And almost no corporate pensions that I've seen hundreds of these pensions, index pensions to inflation. Some of the military pensions do, and there's a variety of pensions in the public sector that the pension will be indexed to inflation, but most corporate pensions do not index to inflation, which means your money's just going to be less valuable over time, and your fixed pension amount is going to buy you less goods and services over time. So the higher inflation rates are, the more of a risk that taking your pension as an annuity becomes. Inflation also affects lump sums in how it affects the investments that you use to invest that lump sum in after you retire and leave the company. So that would be something that I would encourage whoever has this question, have us run a plan comparing the lump sum and the annuity, because there's a variety of different factors that might lead you toward one option versus the other. And they both have their merits and they both have their risks. So that's probably something that you would want to talk to us or your advisor about prior to selecting how to take your pension. All right, question 2, can my monthly pension be adjusted to account for inflation? And so very similar to the first question, most of these companies will never change how much you're getting on a monthly basis after you take that pension. Now, there's things that you can choose to do with that money. If you go back to work after you retire from the company that you were offered a pension from, maybe you consider investing some of that money in an area that will be a good hedge against inflation, such as stocks, maybe real estate, various other investments that will go up in price as prices in the economy go up. That could be a way to offset this. But once you select that pension option, and it's rare for companies to adjust the annuity payments, or in some cases, we've seen companies do pension buyouts where you took the annuity, but 10 years later, for instance, the company comes back to you and says, we're going to offer you a lump sum option now, even though you're already taking annuity payments or you selected this payment and haven't started payments yet. So that we've seen in rare instances to some companies. Typically, that's an irrevocable decision. Once you select how to take that pension, you're going to be stuck with your decision. So it definitely warrants some time and due diligence prior to selecting that investment because of the ramifications long-term to your retirement plan. Question 3, can you explain why value investments do better with inflation than high growth investments? So this is a great question. First, let's compare and contrast value versus growth stocks specifically. Growth stocks are companies that may not be earning any profits today, but that the market expects to earn profits in the future and who have typically been growing at a fairly fast pace. So their current stock prices are typically predicated on future earnings. Value stocks, on the other hand, are typically trading at a better discount to their intrinsic value, and whose stock prices are typically predicated on current earnings as opposed to future earnings. Now, the further out a company's earnings are, the less valuable they are for 2 reasons. One is because inflation is driving down the value of our dollars over time, but also because of the time value of money. Of course, if you ask somebody if you'd rather have $100 today versus $100 in a year, almost everybody, I believe, would say $100 today. And the reason primarily is because they could invest that money and earn, even in a low interest rate environment, some rate of interest, meaning that the present value today is more valuable than the future value. As a result of this, in inflationary environments, higher inflationary environments, the values that these growth stocks who may have earnings in the future, but not necessarily great earnings today, at least relative to their current stock price, that higher inflation and also the higher interest rates that come with higher inflationary environments are going to reduce the current value of that stock more so than a stock who has current earnings and is not necessarily expected to grow by the rate that the growth stock prices are suggesting they will need to grow by just to justify that stock price. So there's a lot of moving parts here, but this is typically why we see in rising interest rate environments as well as in inflationary environments, value stocks perform better than growth stocks. Fortunately, many 401k plans do not have a lot of options for value stocks or options to diversify across the board. And this is why a lot of people will roll over their 401k to an IRA after they retire, and sometimes even before they retire, just to expand their menu of investments prior to retiring, and certainly once they get into retirement. But that's definitely something you would want to review with an advisor, discuss the merits as well as the risks and costs of doing so. Question 4, can I buy value holdings in the 401k, or do I need an in-service distribution to own better inflation hedges? Depends on your plan, depends on the company you work for, because every company, of course, pays money to set up these 401k plans, and not every plan has a very diverse menu of investments. Some are better than others. Not every 401k plan allows for in-service distributions, which is, like I mentioned earlier, you take a portion of your 401k while you're still working and move it out to an account like a Roth IRA or a traditional IRA. One reason, probably the most popular reason people do that, is to have access to investments they didn't have access to inside the 401k. There also could be some tax benefits to doing that, depending on your situation. And then the last reason I've seen people take advantage of an in-service distribution is to do a test run of services of an advisory firm they're considering working with in retirement. I would say probably close to half of my retired clients opened up a small account with us before retirement to see if it was a good fit before retiring with us and investing a larger sum of their retirement assets with us. And I absolutely think that that's at least something to consider, whether it's with our company or another company, so you don't feel like you're making quite as big of a decision with less due diligence at your retirement when you're selecting an advisory firm to work with. Depends on which company you work for, though, whether or not they offer in-service distributions, as well as what investment options they have for you to diversify within the plan. And that's something that we typically review when we review retirement cash flow analysis to see if that's something that might warrant some consideration prior to your retirement. Those were the questions that we had recently to go over today. If you do have additional questions, you can always call us at the home office, 800-900-5867. You can also schedule a conversation with myself or one of my colleagues at the company by clicking on this QR code or taking a picture of this QR code and going to our calendar. Or you can also email us at info@theretirementgroup.com with any questions or to request any of the complimentary analyses that we offer to folks that are approaching their retirement. With that, I'm going to pass it back to you with any last minute housekeeping issues that we may have for today's call, Sam.
Hey, Tyson. No, that was it for me, actually. Don't know if you want to say anything else?
Great. Well, I just want to wish everybody a wonderful and safe rest of your week here, and I hope to talk to you all very soon.
Thank you.